All right, next thing is financial institutions. So what I did so far was a survey of financial instruments. We now need financial institutions. Okay, number one, you study. I'll shorten it for COM as in commercial banks. Commercial banks are financial institutions which make commercial loans and accept deposit. That's it. Accept deposit. Usually we say accept demand deposit. Number two, thrifts. Let's see, what do we have? These will be number 1, 2A, in the form of savings association. Associations. So they'll be providing some sort of savings alternative. Next, savings banks, 2B. Savings banks. Again, notice we got a commercial bank and here's a savings bank. Here, bank has the meaning of accepting deposits, and a savings bank means you accept deposit, usually in some sort of a saving, and making some other loans, meaning making non-commercial loans. They could make mortgage loans, they could make farming loans, they could be making some consumer loans, whatever, something else. If they're making commercial loans, now they're not a savings bank, they are a commercial bank. Next one, credit union. Again, financial institution of a group of people with common characteristic. It may be for retirees. Could be credit union of teachers, credit union of policemen, credit union of some kind of a school, some kind of a job, some kind of a profession where the people put their money in the union, and then we call them, these depositors are not depositors, they are owners of the credit union, and the credit union will make loans to its own owners, to its own, we just call them members. So all teachers will put the money in the credit union, and then the credit union will lend back to the policeman or make loans to the teachers. Okay? We'll soon maybe have to separate, right? Soon, okay? Maybe next time. Number 3, insurance companies. Will be a financial institution which provides insurance contracts. Okay, provides different types of insurance. It could be auto insurance, meaning for cars. It could be auto insurance for motorcycles. It could be insurance, life insurance, meaning in the case of death, and so on. Next one, for A. They call them in general securities firms, okay? And that's a generic term. There will be two types. Investment bank. Investment bank is a financial institution which we say intermediates or supports, or which, let's say, well, just intermediates issuance of financial securities. So they help businesses, corporations, they help others to issue securities. They are an intermediary, okay? So investment bank is not a bank. They don't accept deposits. An investment bank has nothing to do with investments. They don't make investments. They don't have anything to do with investments. It's a name that was designed to mislead people. Back in the old days, it was just called a securities firm, because it's a business, it's a firm that will help others issue securities. The key is that they operate, the investment bank operates on the primary market, the market where securities are issued and funds are raised. 4B will be brokerages. Will be a financial institution that operates on the secondary markets, secondary financial markets. In other words, the market for already existing securities. They help people buy and sell existing securities. They help and provide, we call liquidity. So the function of these is liquidity. If you own a bond or a share, they'll help you sell it. Here, if you need money, they'll help you get it. Thus, this process of raising money is called funding. So the primary function of investment banks is funding on the primary markets, and for brokerages is providing liquidity on the secondary markets. Finance companies, number 5.
Sir,
Yes?
usually the commission fee from brokerage differ from each firm to each firm?
Yes, a commission is simply a payment for a certain service. Usually is a payment for a sales service. Whenever you make a sale, the compensation for making a sale is called a commission, okay? So each firm will have its own commission, okay? So whatever they charge you, okay? Okay. Well, guys, give you a little late for today, okay? Finance companies. They will be providing loans, sometimes consumer loans, okay? The main difference, they can make consumer loans, they can make business loans, they can make commercial loans. But they're not a commercial banks because they cannot accept deposits. The key difference is accepting deposits. Now, these banks will accept deposits but will not be making commercial loans. So, commercial bank will accept deposit, make loans. Some will accept deposits but not make commercial loans. The others will make commercial loans but not accept deposits. And there's a big difference between all of these. Next one will be mutual funds. It is a financial institution that specializes in investing in securities for return to the investor. They will usually be selling, they will be financing by selling shares. So, if it's a mutual fund, when you buy a mutual fund, you buy ownership in the mutual funds, okay? And you get a share. If the mutual fund makes 10% positive return, you get 10% positive return minus costs. But if the fund loses 20%, you lose 20%. In other words, you take all the profits or all the losses of the mutual fund minus the costs of management. Whatever you gotta pay, we call it management fee, okay? You may have mutual funds are highly regulated. They may not borrow money. They are highly regulated. They cannot invest in commodities. In other words, they are told what they can do, what they cannot do, and they're supposed to be relatively safe. A special type of a fund, investment fund, is called a hedge fund. And hedge fund is an unregulated fund. It doesn't mean it hedges. It doesn't mean it lowers risk. A lot of times hedge funds are speculative. They take bigger risks, hoping for higher returns. So a lot of times they take bigger losses. There is no hedging in a hedge fund. Back in the old days, some of those unregulated hedge funds used certain hedging strategies, okay? But that's not a characteristic of a hedge fund. The characteristic is that it is unregulated. They can invest in gold, in oil, in copper, in rice. They can invest in currencies. They can invest in commodities. They can invest in risky bonds. We call these junk bonds. They can invest in anything. They can also borrow money, and we call it leverage. They can borrow money and invest the borrowed money too, to leverage their returns or their losses. So hedge funds are a special type of a mutual fund. And yet another special type, which they give you as a separate entity, is pension funds. Pension is a money given for retirement. Is a money which is given to a person after he completes work, usually for old age, usually after a certain age like 62, but it could be 59, could be 65, okay? And usually given for life, meaning from 62 until you die, okay? And usually it's the same fixed amount, maybe adjusted for inflation, okay? So the tricky part with a pension fund is that you know how many people you have. You don't know how many will live for how long. So you don't know if you're going to be paying 5 years or 15 years. Or maybe nothing at all because the person dies before they get the payments, okay, in a car or motorcycle accident, or heart disease, okay? So here you don't know the payouts, okay? So these are the primary 7 financial institutions, and there may be others, there may be little variations. These don't have to be all financial institutions. They may be a little different from country to country, but you need to understand the basic characteristics of those. Question?
For pension funds, are they allowed to use those money
Again, they allowed.
Are they allowed to use the money to invest in other securities?
Well, that's what they do. Pension funds invest first and foremost in bonds. Bonds supposedly to be relatively low risk. So pension funds will usually be expected to invest in relatively low risk, relatively long-term securities. So they'll be investing in 20 and 30-year bonds. They'll be investing in a wider range of other bonds, supposedly lower risk. They'll be investing in relatively safer stocks, usually non-speculative stocks. And they'll be investing also in a lot of real estate. They'll own real estate like buildings, and they'll be collecting rent on those buildings. So the characteristic of a pension fund, first, it's investment. It makes investment. The second characteristic is that they are selecting relatively low risk. And third, they are selecting long maturity, 10-year, 20-year, 30-year, okay, long maturities. And of course, similar to mutual funds, they are highly regulated. The government wants to make sure that the pension funds of people don't disappear, they don't get lost. So they will be highly regulated. Okay? So these are the main characteristics. Up to here, any questions related to what we're doing in financial economics and the financial system? Any questions?
So what is the difference between mutual funds and exchange traded funds?
Exchange?
Traded funds.
Oh, ETF. Okay, we can do that. Number 8. It's very tricky. Very tricky. ETF stands for an exchange traded fund. It has two meanings, just like money market mutual fund. An exchange traded fund is technically a fund. It's an institution. Financial institution. And it is also a financial instrument. So, as a financial institution, it is an institution that invests in very specific, predetermined securities. For example, they invest only in oil companies. So it's going to be an oil ETF. So it's going to be oil company ETF. They may be investing in oil commodities. It's going to be again, oil ETF. It may be investing in gold. It's going to be a gold ETF, standing exchange traded fund. They invest in gold, and their goal is to approximate the price of gold. In other words, the goal of the ETF is to correlate in price with the underlying asset. Okay? So it's a financial institution. It's an instrument, or it is the instrument issued by that particular institution. It may be a technology ETF. Was going to be a little financial institution, again managed by another financial institution that invests in technology stocks. It could be, let's say, high yield ETF. It's going to be investing in junk bonds. We call these high yield bonds, okay? And they will be paying out whatever the bonds are paying. Now, it's very important to understand, we'll study a lot more in coming weeks, that these are technically, that their true meaning is that of a financial derivative. It is not an underlying security which pays for itself, it's got its own value. If it's a gold ETF, its value is driven and based on the price of gold, okay? But they don't usually own the gold, or will not always have the gold, or all 100%. If it's technology, maybe they own the technology stocks, maybe they don't. Maybe they use other financial derivatives, maybe they use leverage. Well, that's important. That's the most important part, because ETFs as financial derivatives, they introduce an extraordinary amount of risk. Usually, financial derivatives are the cause of a financial collapse. Financial derivatives, we'll study a lot more down the road, will usually cause financial instability and usually are triggers for financial crisis, okay? That's coming down the road. So today, the biggest disaster coming in the financial system is associated with the rise of ETFs. I think something like $3 trillion, okay? It's a huge, monstrous amount of money. We'll talk about it. Other questions? No? Okay. For today, hopefully I can finish. Very difficult because I got one of the most important topics of finance, and the most important topic in finance is risk. Risk. So we sometimes call them financial risks. Financial risk usually means risks associated with financial institutions. But it can also mean risk associated with financial instruments. But it can also mean risk associated with financial markets, okay? So, you have more than 100 different types of risks. Until you understand risk, you don't understand finance. So understanding finance requires expert understanding of risk. Everything else is just talk, okay? So financial risks, let's say associated with financial institutions, again, but they could be with financial instruments such as stocks or bonds or loans. Number one, interest rate risk. Fine. I forgot. Say what's risk, right? Risk is a possibility of an unfavorable outcome. Unfavorable as something you don't want, something you don't like. The most common unfavorable outcome in finance is loss, okay? The favorable is called return, profit, gain, okay? Unfavorable is loss. So interest rate risk is risks associated or risk of loss associated from changes in interest rates. Sometimes interest rates go up and the price of bond goes down. So you have a risk that your bonds will lose value, okay? Your real estate may lose value, okay? So it's simply a risk of taking some kind of a loss that is caused by change in interest rate. Well, it could be the opposite. Interest rates can fall, and before you were getting 7% interest on your bond, now you can take only 1%. So before you were collecting 7, if interest rates fall, you gotta reinvest your money, and when you reinvest it, you take a lot lower return. So one of the most common types of interest rate risk is called reinvestment risk. Is the risk that when your investment matures and you get your money back, when you want to reinvest that money, the interest rate will be significantly lower. Number two, foreign exchange risk. That's probably for you guys the easiest of all to understand. Foreign exchange risk. Is the risk of loss, because foreign exchange is short for currency, for paper money. The risk of loss because the exchange rate of a currency or the value of a currency moves against you. In other words, maybe you have local money, okay, and the value of local money falls against the dollar. So you take a loss on your local money. Okay? Or maybe you invested in euro thinking that the euro is safe, and then the price of euro falls against the dollar or against your own currency. Okay? So somewhere, somehow you invested in a currency and that currency falls in value. It could be the opposite. You borrow in a currency. For example, you borrow in Japanese yen. The Japanese yen goes up and now you gotta pay in more expensive yen. So one way or another, the exchange rate was unfavorable. You invested, you were, we say, long in a currency and the currency fell, or you were short in another currency and that currency went up in value. We say that, the currency you were long depreciated or the currency you were short appreciated. Next one is market risk. Sometimes they call it price risk. It's got two completely different meanings, which makes it one of the most confusing. Market risk is associated with the risk with all prices in the stock market moving up or down. It's a little tricky. I'll try to get to that if I have time. But here, market risk simply means that the prices of securities you trade go unfavorable. So it's the risk of loss from holding or trading particular securities. You bought IBM and IBM went down. You bought to trade Japanese yen and the Japanese yen went down. You bought some bond, the bond went down. You bought a commodity. So here, this one is meant to be associated with trading and what's called trading portfolio. It's associated with a trading portfolio of a financial institution. You just bought something and within a day or two or a week the price went down. So you're taking a loss. That's the risk you're taking whenever you're buying any asset, okay? Whether it's real or financial, you're exposed to the risk that its price will fall. Credit risk. Is the risk that a loan might not be paid in time and in full. Credit risk is associated with credit, usually mean loans, or bonds. Now, if you go with US Treasury bills, they have some credit risk that the US government might not pay. The risk is very low, maybe 1 in a million, okay? Same thing, commercial paper. There is a credit risk. You lend for 90 days that the company will not be able to pay, but the risk is relatively low. The risk that they can't pay back a loan or they can't pay back. Same thing applies for negotiable CDs. Same thing applies for any instrument has a credit risk as long as there's some lending involved, except for stocks. Stocks do not involve any loan or credit, so stocks are the only ones that don't have any credit risk. Next is liquidity risk. This is the risk that when you own a security, when you try to sell it, you cannot sell it well. In other words, it's the risk that you cannot get the full price of a security when you want to sell it. Or it's the risk that you cannot sell it for a security quickly for a full price. Well, that's the meaning of liquidity. Liquidity means ability to sell a security quickly for a full price, meaning close to market price, to its market value. Well, the risk is you will not be able to sell it if you want, when you want. That's the risk. It happens a lot. 6 of balance sheet risk is associated with usually liabilities which are not on the balance sheet but may have to be put on the balance sheet. We call these, and I'll explain a little more, we call these contingent liabilities. It is a liability that is not certain. It is a liability. It may happen, it may not happen. The best example is insurance. You insure his motorcycle for 1 year. Maybe the motorcycle gets stolen, maybe it doesn't get stolen. You expect it not to get stolen. Maybe health insurance, the person may get sick, may not get sick. So, contingent liabilities, maybe you have to pay, maybe you don't have to pay. Well, the risk is that you expect not to pay, but you will have to pay. So, you gotta make a payment that you did not expect. This payment, it was not a liability on the balance sheet, it was off balance sheet, and it had to become on the balance sheet. So it was contingent. Contingent liabilities are off the balance sheet. When they become real or actual liabilities, you have to put them on the balance sheet. Okay? Next, technology risk. You have very many different types of technology, but the basic definition is that technology risk is the risk that technology will not work as designed. Maybe technology will fail. You're a bank and you have many deposits. Somebody hacks into your system, okay, and steals the deposits from you. Well, that could be also called operational risk. But sometimes you expect to buy, sell certain transactions, the computer system is down. The database gets corrupt, okay? Somebody hacks your website. So somehow you get a disruption or loss of business or loss of value because you have a technology that's expected, supposed to work in a certain way. It has been working in that way for a while, but then for some reason technology breaks and doesn't work the way you think it's supposed to work. And you're all familiar, we play with these little toys, right, like the iPhones, and it works most of the time, but sometimes it freezes, sometimes it doesn't work, sometimes you push the button, nothing happens, okay? That happens to all sorts of technology and computer systems. Let's see, yeah, I think we gotta get these two guys separated. It's about time, right? Is it about time, right? I mean, I see you're having too much time. Who's gonna move? Which one? Yeah, about 6 minutes, that's good enough, right? For 6 minutes, it's worth it, right? Okay, operational risk, number 8. Operational risk is actually the risk that operations may not work properly. It could be that employee steals the money, okay? It could be that technology doesn't work. So technology risk is usually considered part of operational risk. Operational risk could be something like there is a flood. You know, flood, water comes in, it fills the whole building and destroys important documents. It could be some sort of a natural disaster, okay? These, where they come from, we call them in English, it's a special word, it's a legal word, don't think of it. It's called acts of God. Acts of God will mean natural disaster. Lightning, earthquake, flood, okay? This is just an English language legal term, act of God. We call these type of risks related to acts of God event risk. Usually associated with a natural disaster. Of course, you may have a little different type of an event risk, and it may fall under a different category, like war, like a revolution, okay, where suddenly people start shooting each other for some reason. Okay. Number 9. Again, it could be part of it. It's called country risk. Sometimes called sovereign. Sovereign. Sovereign risk is the risk associated with the whole country in general. The biggest one is a revolution. Suddenly, political instability. We just had it 2 years ago in Thailand. Well, it may be civil war, 2 different people, maybe 2 different religions. For whatever reason, they start fighting against each other. It could be a war with another country, okay? Right now, you got big sovereign risk associated with Syria. Syria is in a form of war, where internally it is civil war, and then one side supported by the Americans and whoever, another side supported by the Russians. Now, one of the biggest sovereign risks over the last just couple of weeks is Turkey, okay? Suddenly the government seizes a newspaper. Oh, well, this means sovereign risk is associated also with government taking your assets, okay? We call this expropriation. Or the laws change. Or it may be just a simple innocent thing like taxes change. Everyone was paying 10% tax, and now everybody's got to pay 50% tax, especially foreign companies, okay? So somehow the risk is associated with the whole country, and it does not have to be political risk, okay? It's somehow related to, could be economic risk, could be social risk, could be something else, but it is related to that particular country, and usually does not involve other countries. For example, whatever is happening politically in Turkey, Bulgaria, which is my home country, neighbors Turkey, is not affected by Turkish internal developments, okay? So, it's strictly to Turkey, does not affect Greece, does not affect Bulgaria, okay? So that's typical country risk. Next, insolvency, number 10. Insolvency. Risk is the risk that the financial institution becomes insolvent. Now let's try to do the meaning of the word. Insolvent is a little confusing, but it has one main meaning. The meaning is that liabilities exceed assets. In other words, you have more obligations than you have assets to satisfy them. A different way of saying is that the company has a negative equity, negative owner's equity. In other words, the company will not be able to meet its obligations, and most likely the company will go bankrupt. And now, between insolvency, we need to clarify what is bankruptcy. A company may be bankrupt, but not insolvent, or a company may be insolvent, but not bankrupt. And a lot of times, an insolvent company will become bankrupt. Bankrupt simply means a legal proceeding to recover obligations. So bankruptcy is the legal procedure that a creditor asks the court for payment. So bankruptcy is a procedure that involves the court. Okay? Well, these are the 10 primary risks. All right.